Welcome to our deep dive into transfer tax and stamp duty. In this video, we'll break down these critical financial concepts, explain their implications, and give you real-world examples to help you grasp their significance. First, let's define transfer tax. A transfer tax is a fee imposed by the government on the transfer of property, title, or assets from one person to another. This transfer can occur through various means, such as sales, inheritance, gifts, or exchanges. To make this clearer, let's consider an example. Imagine you bought a house for $300,000. Depending on your location, the government may charge a transfer tax rate. Let's say it's 1%. This means you would owe $3,000 in transfer tax. Next, let's move on to stamp duty. Stamp duty is another type of tax that is levied on legal documents, typically involving the sale of assets or property. Essentially, it's a tax on the paperwork that verifies the transaction. For instance, suppose you purchase a property worth $450,000. The stamp duty rate is 1.5%. You would pay $6,750 in stamp duty to finalize the transaction. So, what's the difference between transfer tax and stamp duty, you ask? While both are taxes related to property transactions, transfer tax is primarily concerned with the overall transfer of ownership, whereas stamp duty specifically targets the legal documentation confirming the transfer. Now, let's dive into some data to understand the impact of these taxes. We'll look at average transfer tax rates across different states in the U.S. and how they compare. As we see, the rates range from 0.5% in Texas to 1.5% in New York. This variance can significantly impact your total costs when buying property in these states. Next, let's examine average stamp duty rates across different countries. For this comparison, we'll use data from the UK, Canada, Australia, and Germany. UK and Australia lead with a 2% stamp duty, while Germany has the lowest rate at 1.2%. These rates can add up to significant amounts, depending on the value of the property transactions. Let's answer some commonly asked questions about transfer tax and stamp duty. Question: are transfer tax and stamp duty deductible against income tax? Answer: generally, transfer tax and stamp duty are not deductible against income tax because they are considered capital expenses. However, they can add to the property's cost basis for capital gains purposes. Question: when is transfer tax due? Answer: transfer tax is typically due at the time the property is transferred. This is generally during the closing process of a transaction. Question: can stamp duty be rolled into a mortgage? Answer: while transfer tax and stamp duty are usually paid up front, some lenders offer to roll these costs into the mortgage. However, you'll need to check with your lender for specific terms and conditions. Question: what happens if I don't pay the transfer tax? Answer: if transfer tax is not paid, you may not be able to legally transfer ownership of the property. Moreover, penalties and interest may accrue until the tax is paid. In conclusion, transfer tax and stamp duty are essential components of property transactions. Understanding these taxes, their rates, and when they are due can help you better prepare for buying or transferring property. Thanks for watching. Don't forget to subscribe and hit the bell icon for more finance tutorials. Feel free to leave your questions in the comments below. See you in the next video.